Unless you've been living under a rock for the last couple of weeks, you may have noticed that there have been a lot of craziness going on in the stock market, specifically with stocks like GameStop, AMC, and a couple others, where out of nowhere, basically overnight, their stocks are going up. Now, this is due to what's called a short squeeze, and I wanted to make a video to kind of dive down a little bit deeper and understand what's going on and why this has all happened. So for starters, what a short squeeze is, it's a jump in a stock price forcing a lot of those short sellers to close on their positions, which in turn pushes the stock price even higher. Now, to understand what that really means, we have to understand what a short sale is. So when you're shorting a stock, you're basically making a bet against the company or stock that you're shorting with the anticipation that it's going to go down even further, and the further that it goes down, the more money you can make. So the steps to doing this would follow basically these four. You would borrow the stock, so you don't own the asset, and then you would sell it right away to get essentially the money at that price at that point. You would wait for the stock to go further down. You would buy back the stock at a lower price, and then you would return it back to where you borrowed it from, and you would pocket the difference. Let's say GameStop stock, for example. So let's say this is you, and you're looking to short the stock. So what you're going to do is you're going to borrow one share, or however many shares you want to do. For the sake of simplicity, we're just going to do one. And then let's assume the stock price right now is $10. You're going to go around right away and sell it. So you no longer have the stock, but you have $10. Now, if you are profitable, what you're going to do is you're going to wait, and when the price goes down to, let's say, $5, you're going to buy that stock back. So wherever you sold it to, or just in general from the market, you're going to pay $5, and you're going to get the stock right back. And then you can return it, which in turn closes your short position. So now, you borrowed, you returned it, you got $10 initially, and then you paid $5 to get it back, so you profited $5 per share. Now, this may seem like a small number, but keep in mind when you're doing millions of shares, you're going to have exponential growth as you do more and more. Now, this only works if the stock price goes down. So what happens if GameStop goes up to $20? Well, you're going to have to pay $20 eventually to get that stock back, or you can wait and hope that it goes down, but keep in mind you're eventually going to have to close and cover your position. So in this case, let's say it went to $20, well, you're going to pay $20, and you're going to return that share that you borrowed, and since you got $10 initially when you sold the stock, you're losing $10 per share. Now, if this happens a lot, you can have this backfire on you with what's known as a short squeeze. So in this case, there was a Reddit post, and I forgot the number, but it was over 100% of the shares of GameStop were shorted. Now, the way that you can go over 100% is you can short the stocks that are being sold and basically being shorted multiple times. So if you have this person shorting the stock and borrowing it, the person you sell it to can also short the stock. So the same share can be shorted multiple times, driving you to over 100%. Now, the reason this causes a short squeeze and the inflation of the price artificially is because everybody that's shorting is at some point going to have to buy the stock back, and when you're buying the stock back, the price is going to keep going up because of supply and demand. So that's where Reddit comes in, and they recognize this inefficiency in the market for this stock, and they pretty much bought up a lot of the shares, causing the stock price to go up and forcing some of the short sellers to start buying back some of their shares. But as they're doing that, the stock price kept going higher and higher, forcing everybody that's shorting with still an open position to have to either wait or take on even more losses. So to explain the severity of this, let's assume that there was a hedge fund that shorted the stock at $10, right? And let's assume they shorted 1 million shares. Well, if they were to close their position today, and just to keep things simple, we're just going to round it to $300. To close their position at the stock price of $300, they would have to pay $290 per share, and that's all pure loss. Well, they would pay $300, but they got $10 when they shorted it. So they essentially lose $290 million. If it goes up to $400, well, then they lose $390 million to cover up their entire position. Now keep in mind, as they're trying to cover, that's a lot of demand. So they need to be able to buy 1 million shares. So as they're buying those shares, the stock price is going to keep going higher and higher to, I don't really know how high it can go, but it's going to keep going up until they can close and cover their position. So again, this is just an example with one hedge fund at 1 million shares, but there are tens and tens of millions of shares that have been shorted. So this can keep going up for a while. I just took a look at an article, and it looks like as of the 29th of January, they've been able to close or cover about 8 million shares of their open positions, but they still are at over 100% in shorted stocks. So they're likely to keep losing tens and billions of dollars, but we'll see how long this can keep going. Now keep in mind, when this is all over and the shorted positions have been covered, the stock price is going to tank right back down. So if this is something you're interested in, keep in mind this is not going to last forever. But if you want to keep riding the wave, you might be able to make some money, but you never know what's going to happen. So it looks like for now it's going to be a game of chicken between Wall Street and all the Reddit and retail investors to see who's going to cave first. But we also have seen some form of market manipulation. As of Thursday, for example, some trading platforms like Robinhood were restricting buying of shares, and the only thing you could do was sell to allow others to close their position. And by doing that, they drove the stock price down. So who knows what's going to happen? Who knows what the SEC is going to do? But for now, it looks like it's going to be a game of who caves first and gives up. So with that being said, thank you guys for watching. I hope you found this informative. I definitely learned a lot in researching this topic, and I do think it's really interesting to see what happens. So please consider liking and subscribing for more.